Good morning, traders. My name is Charles, and this is the Pirate Traders live stream. We are going to talk about the ES, the NQ, and how it moves throughout the two-way auction process, and today should be a doozy. 10 a.m. is going to bring in the party. Why? Well, we got two things happening. First off, we got the Michigan sentiment. That's going to give us a little bit of volatility in and of itself. And we got Papa Powell speaking at Jackson Hole at 10:05. And that will most certainly bring in some volatility. So let's just take a minute to kind of cover what I'm expecting here today. So first and foremost, the move that we did yesterday brought us right back down to the balance area low. This is extremely common to see before the FOMC or before, so this is the balance area right here. Okay, it's a range the market gets stuck in where it bounces up and down in between the range. And it is extremely common to be either at the high or the low of that range on a day like today where the market is likely to make a big move one way or another. Why do I say that? Well, a lot of what we experienced yesterday was people preparing for today. It was people who were positioning themselves for what they think is going to happen as a result of Jay Powell speaking. And it was people hedging themselves, hedging their portfolios. And it was people, market is open, and it was people taking risk off, right? All of those things were happening yesterday, and they brought us right back to the balance area low. So this morning, I'm really just expecting chop. I'm expecting the market to grind around between the 44.20 and the 43.90 levels and basically just grind up and down and up and down and up and down for the next half an hour until Papa Powell starts to speak. But once he starts to speak, things should get interesting. Okay? The reason they should get interesting is because obviously, there's going to be bots that are taking trades based on the things that he's saying, bots that just read the headlines and react. There's going to be traders who are reacting. All right, so we are above the overnight high. That's a little bit bullish to see. Can they turn that into support? The traders are going to be reacting. So the market's going to be moving all over the place while Powell is speaking. But once he's done with his talk, all of the preparations that were happening need to play out. So the speculators who got into positions that are right, let's say he finishes speaking and the market goes up, if they're long, they're going to have to take profit somewhere. If they're short, they're going to get squeezed out of their trade, so on and so forth. So there is likely to be some interesting volatility here today, which as a trader always gives us opportunities. So for the next half an hour, it's probably going to be, not that interesting. Like I said, just some chop, just some grind while the market treads water and waits to hear if Papa Powell is going to be hawkish or not. Got the survey going right now. Last chance to vote. What do you think is going to happen? Do you think this market is going to take off to the moon? Do you think we're going to turn around and immediately start heading? Immediately start heading right back to that balance area high. So as we talked about on Monday, the look below and fail increased the odds that we were heading up towards the high. That could happen again today. The overnight was another look below and fail. Do you think we're going to the moon, baby? Or do you think Powell's going to scare the market and we're going to crash and burn lower, breaking out of balance to the downside? Or do you think just nothing's going to happen and we're going to just chop around inside to yesterday's range, doing nothing? What is your guess? Let us know in the survey. Okay, support at the overnight high is bullish to see. It increases the odds that we will repair the weak reference we left behind at 44.0950, which we're doing right now. Once we repair that weak reference, we will once again look for support here at that overnight high to see, can they get enough support to head for the next one? If not, they'll come back down into that overnight range. That is how chop works. And they're chopping it up. So that right there, that box that you see, that is pretty much the chop zone. That's the area I think we're probably going to be stuck in until Papa Powell speaks at 10:05. The results are in. Oh, man. Got a mixed bag here. That's not helpful at all. So 40% of you think nothing's going to happen. We're just going to go sideways today. 35% of you are looking for the market to crash lower. And only 24% of you think that this is going to be a move back up towards the opposite end of bounce. So if history repeats, that means the actual highest probability is that we're going to the moon, because generally the survey is wrong. But honestly, with 40, 35, 24, anything could happen, which is as it should be. If you haven't hit that like button yet, you haven't hit that thumbs up, please do that. It really helps out the channel. It just tells the YouTube algorithm that, you think I'm a good guy. You think I have a sexy voice. Whatever reason you push the like button. All right, let's pop over and take a quick look at the NQ. I have a feeling it's probably in exactly the same position, but we'll just see. Yes, sir. NQ exactly the same as the ES. A little bit wider range, but you're looking for a chop zone basically between 1500 and 14, let's call it 830. That's your chop zone. If they can hold the support here at the J period high, the overnight high, that would be bullish for another push up. If they pull back down into the overnight range, they're likely going to head back through that opening price and chop it on down. Because it's a chop zone. One more tick. Boop. There we go. All right. That is the repair of that weak high. So now we are looking for the market to turn this area right here around 44.06 into support. If when they pull down, the market can hold there, they're likely to head up and try to get that next week reference. If they pass back through the halfback, we're likely to go through the opening price. If we go through there, chopping on down, looking for support. We got 122 people hanging out and only 62 likes. That means half of you hate me. You hate me. What did I ever do? Okay, so we're testing that halfback now. Can they hold it? No, they cannot. All right. So the next question is, do we pass through the opening price? Passing through the opening price would increase the odds we're heading lower to test some support inside the overnight range. Good morning to Nap. David A says Jerome equals total devastation. But total devastation for who, David? For the longs or for the shorts? Half these participants are going to win and half are going to get squeezed. Good morning to the Haas, to Jonathan, to Gino. Frito says, public stream today. Let's not be our normal jerk-off selves. No, please, Frito, be your normal jerk-off self. I wouldn't have it any other way. John says, popcorn for breakfast, anyone? I'm telling you, that's the way to handle this. I'll play the Jerome Powell video, and we'll just sit back, relax, and watch the show. It'll be how the market reacts to it, and then when he's finished, the continuation of that, right? So let's say as he's talking, it's going up and down and up and down. But then he finishes speaking and it's going up, it'll probably keep going up, right? Or if it's going down, it'll probably keep going down because the other side will have to cover. Good morning to Mike, who thinks. Pavel, good to see you. Peter, good morning to you. Maya, hello. RK says negative poll based on last year, which was entirely different scenario. That's the tricky thing, man. All right, well, we now have just turned the overnight high into support. That is a little bit bullish to see. Increase in the odds. We're heading up to test 44.15. Can they hold it? That's the tricky thing, like I said, about something like this, Jerome Powell speaking, is because whatever happens is going to be as much based on how participants are positioned for it as what he says. You know what I mean? It doesn't matter if what he says is bullish or bearish. It matters if the market is more hedged that direction or not. You know what I mean? So truly anything can happen. Good morning, Alex, David G, Scalping Strategy, I Trade, Mr. Ree. Deborah in the house. iTrade said someone in the Discord mentioned the 80% strategy. I've been using that and it really helps. Do you do that too? What's the 80% strategy? I don't know what that is. $777. Good morning to you. ES Trade Monkey in the house. Man, they are dancing on the halfback. Can they hold it? Let's take a look at the ticks. There you go. Right at the zero line. So we should get some information whether we need to pull back down or whether we can head on up to repair that next reference based on what happens here at the zero line. If it holds and we start heading back higher, they're going for the weak reference. If it breaks, we're pulling back for support. Because it's a chop zone. Good morning, Ebb and Flow, Travis, Malang, Chris Yee. Chrissy says, push Charles's thingy to show support. Don't touch my thingy, okay? But please smash that like button. David G says, NVIDIA getting smoked? Say it ain't so. Well, looks like it's going up to me. Going up. Ding. Yeah, they just filled a gap down. They're good. Boy, what an exciting morning. Good morning to Pete is. Bust a Move. Bust a Move says, do you have your market profile available as a template to use? Yes, absolutely. If you have Window Trader, the software that I use, you can either email me and I will email you my template, or if you're a member of the brigade, the Pirate Traders Brigade, $10 a month, those links are in the Discord and you can download them there. Good morning, Usia, 200 dogs, Ken, Will, Scooball, Mac Vins, J Trader. Will says, A-hole in J-hole? Don't you dare. Don't you dare speak disparagingly of Papa Pal. The man has guided us into a soft landing in an impossible scenario. You respect J Pal. They don't call him Papa for nothing. Okay, so once again, we held that support at the halfback. We've got the ticks. So again, odds are now favoring, heading up towards 44.15. Can they do it? David says, I clicked the like first thing when I logged in. I love you, man. I love you too, David. Appreciate you, brother. Welcome, Nani. PSC. Happy Friday. RK's on my page about Papa Pal. iTrey said, where do we watch Daddy Pal? Well, I'm going to play the video right here if you want to watch it with us. Or you could just Google it, or search for it on YouTube. Gino, what does smoking a banana mean? Should I ask, or is that something I don't want to know? Scott says the ES has been so exciting. Meanwhile, the NQ, I'm almost done for the day. I wouldn't stop today. There's going to be some opportunity. Like I said, half this market is going to be wrong. Everyone's positioned for what they think is going to happen. We saw in the chat. It's very split opinions. Trading Futures Daily says, do you live stream for the members every day? I do. And if you're trading Futures Daily, you should hang out with us because we're talking Futures Daily. Burrito. Does that explain the 200 dogs? Mark, yeah, I was able to recover the banners. Good morning, Alan. David says, if the NQ crosses over 15,020, is that bullish? All right, well, the ticks are failing, and we're about to pass through the opening price, so that would increase the odds. We need to pull back, looking for support. Again, it's a chop zone, so they probably won't pull back very far. If we pass through 15,020... yeah, I'd push it a little further than that. I'd say like 30, 15,030, because we've got this large node of cumulative volume right here. We've got the fading off of the volume right here, and then we've got the little bit of extra time right here. So that to me is sort of a more important level. But yeah, if we can get through there and then turn it into support, that is very bullish. As a look below and fail of the... actually, no, it's not. Sorry, on the... NQ, you're just inside of balance right now. But yeah, that would be bullish. I don't think it's going to happen, though, not till after Papa Pal is finished. I have a feeling they'll get smacked down right here, and then smacked down right here, and then smacked down right here. And we'll just chop it up. We're getting closer, though. 12 minutes from Papa Pal. iTrade says, is yesterday's closing range important to watch? So I think what you mean is the spike down. This move that we made in the very end of the day, that was what we call a spike down, because the market made a new low in the last hour and it closed at that low. So the way we would normally read that is we would say today, because we opened, I mean, we barely opened above it, but we did open above it. That would mean that is the least bearish scenario. Not bullish, just least bearish. But again, today, nothing really matters. TA is out the window. Once Papa Pal starts speaking, anything can happen. So really, we must just be patient and wait. David says, what is the time frame for the orange volume, the cumulative volume here on the left? It's like the last 200 days combined. It's a cumulative of all the days put together. Ooh, we got 135 people hanging out and 93 likes. Can we break 100? Are there 7 brave souls willing to push a button? One small push for you. One giant nice thing for me. Anabolic steroid? Anabolic steroid. Why is the 15-minute on the tick chart? There's nothing special about the 15-minute. It's just when I used to trade with candlesticks, I used 15-minute candlesticks. So I was just used to that time frame. So when I started learning the internals, I just kept it the same. But it doesn't matter. You could look at the ticks in whatever time frame you want. They just give you an idea of what the momentum is doing right now at this moment. So whether you're looking at the candle right now and it's a 1-minute candle or a 5-minute candle or a half an hour, whatever, it's still the same information. But I keep all my market internals at 15 minutes just to keep it, synchronicity. $777 100 is resistance at this point. Yeah. We got resistance in the like. Oh, we broke through. Now can we turn it into support? All right, so we got that Michigan sentiment, which is coming out in 2 minutes. We should get a little bit of volatility from the news bots just purely based on that. And then a few minutes later, you know who. Darth Liquidity, you didn't take the 04 to 07 trade. I did not. Long before the market opened this morning, I said to myself, Charles, there's no reason to trade the chop. It'll be boring. It'll be uncertain. It'll be difficult to read. Might as well wait and see what Papa Powell has to say and then how the market reacts to that. That is where I believe the greatest opportunities will be today. As I've said, with an event like this, it's a combination of two things, right? It's the event itself. It's the fact that some people are positioned one way, some people are hedged one way, and whichever way it goes, they will either add to, you'll get FOMO buying or FOMO selling, or you'll get taking profits or whatever. And then also it's the fact that we're right back at that balance area low on the daily. So if you understand the two-way auction process, when you get to this level in here, the market is either able to break lower, which leads to further downside continuation, as you can see here when we broke out to the upside, right? Or it turns around and it heads right back up towards the opposite end. So we're back, baby. We did it again in the overnight last night. So it could be exactly the same as it was right, as it was right, chaw. This candle could be telling us we've got this to come, right? But we don't know. I mean, because anything could happen with the Jackson hole. So we'll just wait. But then when it breaks, we'll see what happens next. You know, there'll be some opportunities. Okay, Bookmap's going dark. Let those Michigan news bots do their thing. I trade. Don't you put that on me. I don't want that responsibility. Amari says, I'm not sure how, but the spike up 4 minutes ago gave me $870. Think I'm done? Papa Bal might take it back. Absolutely. There's two ways to think about that. If you're happy with your profits for the day and you don't want to give it back, you could choose to either completely walk away, right? Or you could say to yourself, I'm going to stay and keep trading. But first off, I will be much more cautious. I'm not going to FOMO in. I'm not going to chase. I'm not going to emotionally trade. I'm going to only wait for those A+ scenarios. Or I'm going to size down. So even if I do trade, I'm not trying to make a ton of money. I'm good. I'm happy with the money I've made today. So I'll size down and take away some of the risk, you know? Breaking! University of Michigan sentiment was actually 69.5 when it was forecast to be 71.2. Oh no! Ah! How is Powell already speaking if we don't have the video yet? What's up, CNBC? Here we go.
Chair Powell, the floor is yours.
That was brief. And I know brief. Thank you, Betsy, and good morning, everyone. At last year's Jackson Hole Symposium, I delivered a brief, direct message. My remarks this year will be a bit longer, but the message is the same. It is the Fed's job to bring inflation down to our 2% goal, and we will do so. We have tightened policy significantly over the past year. Although inflation has moved down from its peak, a welcome development, it remains too high. We are prepared to raise rates further if appropriate and intend to hold policy at a restrictive level until we are confident that inflation is moving sustainably down toward our objective. Today, I will review our progress so far and discuss the outlook and the uncertainties we face as we pursue our dual mandate goals. I will conclude with a summary of what this means for policy. Given how far we have come, at upcoming meetings, we are in a position to proceed carefully as we assess the incoming data and the evolving outlook and risks. The ongoing episode of high inflation initially emerged from a collision between very strong demand and pandemic-constrained supply. By the time the FOMC raised the policy rate in March 2022, it was clear that bringing down inflation would depend on both the unwinding of the unprecedented pandemic-related demand and supply distortions and on our tightening of monetary policy, which would slow the growth of aggregate demand, allowing supply time to catch up. While these two forces are now working together to bring down inflation, the process still has a long way to go, even with the more favorable recent readings. On a 12-month basis, U.S. total or headline PCE inflation peaked at 7% in June 2022 and declined to 3.3% as of July, following a trajectory roughly in line with global trends. The effects of Russia's war against Ukraine have been a primary driver of the changes in headline inflation around the world since early 2022. Headline inflation is what households and businesses experience most directly, so this decline is very good news. But food and energy prices are influenced by global factors that remain volatile and can provide a misleading signal of where inflation is headed. And in my remaining comments, I will focus on core PCE inflation, which omits the food and energy components. On a 12-month basis, core PCE inflation peaked at 5.4% in February 2022 and declined gradually to 4.3% in July. The lower monthly readings for core inflation in June and July were welcome. But 2 months of good data are only the beginning of what it will take to build confidence that inflation is moving down sustainably toward our goal. We can't yet know the extent to which these lower readings will continue or where underlying inflation will settle over coming quarters. 12-month core inflation is still elevated, and there is substantial further ground to cover to get back to price stability. To understand the factors that will likely drive further progress, it is useful to separately examine the three broad components of core PCE inflation: inflation for goods, for housing services, and for all other services, sometimes referred to as non-housing services. Core goods inflation has fallen sharply, particularly for durable goods, as both tighter monetary policy and the slow unwinding of supply and demand dislocations are bringing it down. The motor vehicle sector provides a good illustration. Earlier in the pandemic, demand for vehicles rose sharply, supported by low interest rates, fiscal transfers, curtailed spending on in-person services, and shifts in preference away from using public transportation and from living in cities. But because of a shortage of semiconductors, vehicle supply actually fell. Vehicle prices spiked, and a large pool of pent-up demand emerged. As the pandemic and its effects have waned, production and inventories have grown and supply has improved. At the same time, higher interest rates have weighed on demand. Interest rates on auto loans have nearly doubled since early last year, and customers report feeling the effect of higher rates on affordability. On net, motor vehicle inflation has declined sharply because of the combined effects of these supply and demand factors. Similar dynamics are playing out for core goods inflation overall. As they do, the effects of monetary restraint should show through more fully over time. Core goods prices fell the last 2 months, but on a 12-month basis, core goods inflation remains well above its pre-pandemic level. Sustained progress is needed, and restrictive monetary policy is called for to achieve that progress. In the highly interest-sensitive housing sector, the effects of monetary policy became apparent soon after liftoff. Mortgage rates doubled over the course of 2022, causing housing starts and sales to fall and house price growth to plummet. Growth in market rents soon peaked and then steadily declined. Measured housing services inflation lagged these changes, as is typical, but has recently begun to fall. This inflation metric reflects rents paid by all tenants, as well as estimates of the equivalent rents that could be earned from homes that are owner-occupied. Because leases turn over slowly, it takes time for a decline in market rent growth to work its way into the overall inflation measure. The market rent slowdown has only recently begun to show through to that measure. The slowing growth in rents for new leases over roughly the past year can be thought of as in the pipeline and will affect measured housing services inflation over the coming year. Going forward, if market rent growth settles near pre-pandemic levels, housing services inflation should decline toward its pre-pandemic level as well, and we will continue to watch the market rent data closely for a signal of the upside and downside risks to housing services inflation. The final category, non-housing services, accounts for over half of the core PCE index and includes a broad range of services, such as healthcare, food services, transportation, and accommodations. 12-month inflation in this sector has moved sideways since liftoff. Inflation measured over the past 3 and 6 months has declined, however, which is encouraging. Part of the reason for the modest decline of non-housing services inflation so far is that many of these services were less affected by global supply chain bottlenecks and are generally thought to be less interest sensitive than other sectors, such as housing or durable goods. Production of these services is also relatively labor intensive, and the labor market remains tight. Given the size of this sector, some further progress here will be essential in restoring price stability. Over time, restrictive monetary policy will help bring aggregate supply and demand back into better balance, reducing inflationary pressures in this key sector. Turning then to the outlook, although further unwinding of pandemic-related distortions should continue to put some downward pressure on inflation, restrictive monetary policy will likely play an increasingly important role. Getting inflation sustainably back down to 2% is expected to require a period of below-trend economic growth, as well as some softening in labor market conditions. Restrictive monetary policy has tightened financial conditions, supporting the expectation of below-trend growth. Since last year's symposium, the 2-year real yield is up about 250 basis points, and longer-term real yields are higher as well by nearly 150 basis points. Beyond changes in interest rates, bank lending standards have tightened, and loan growth has slowed sharply. Such a tightening of broad financial conditions typically contributes to a slowing in the growth of economic activity, and there is evidence of that in this cycle as well. For example, growth in industrial production has slowed, and the amount spent on residential investment has declined in each of the past 5 quarters. But we are attentive to signs that the economy may not be cooling as expected. So far this year, GDP growth has come in above expectations and above its longer-run trend, and recent readings on consumer spending have been especially robust. In addition, after decelerating sharply over the past 18 months, the housing sector is showing signs of picking back up. Additional evidence of persistently above-trend growth could put further progress on inflation at risk and could warrant further tightening of monetary policy. The rebalancing of the labor market has continued over the past year but remains incomplete. Labor supply has improved, driven by stronger participation among workers aged 25 to 54 and by an increase in immigration back toward pre-pandemic levels. Indeed, the labor force participation rate of women in their prime working years reached an all-time high in June. Demand for labor has moderated as well. Job openings remain high but are trending lower. Payroll job growth has slowed significantly. Total hours worked has been flat over the past 6 months, and the average work week has declined to the lower end of its pre-pandemic range, reflecting a gradual normalization in labor market conditions. This rebalancing has eased wage pressures. Wage growth across a range of measures continues to slow, albeit gradually. While nominal wage growth must ultimately slow to a rate that is consistent with 2% inflation, what matters for households is real wage growth. Even as nominal wage growth has slowed, real wage growth has been increasing as inflation has fallen. We expect this labor market rebalancing to continue. Evidence that the tightness in the labor market is no longer easing could also call for a monetary policy response. Turning to the path forward. 2% is and will remain our inflation target. We are committed to achieving and sustaining a stance of monetary policy that is sufficiently restrictive to bring inflation down to that level over time. It is challenging, of course, to know in real time when such a stance has been achieved. There are some challenges that are common to all tightening cycles. For example, real interest rates are now positive and well above mainstream estimates of the neutral policy rate. We see the current stance of policy as restrictive, putting downward pressure on economic activity, hiring, and inflation. But we cannot identify with certainty the neutral rate of interest, and thus there is always uncertainty about the precise level of monetary policy restraint. That assessment is further complicated by uncertainty about the duration of the lags with which monetary tightening affects economic activity and especially inflation. Since the symposium a year ago, the committee has raised the policy rate by 300 basis points, including 100 basis points over the past 7 months. And we have substantially reduced the size of our securities holdings. The wide range of estimates of these lags suggests that there may be significant further drag in the pipeline. Beyond these traditional sources of policy uncertainty, the supply and demand dislocations unique to this cycle raise further complications through their effects on inflation and labor market dynamics. For example, so far, job openings have declined substantially without increasing unemployment, a highly welcome but historically unusual result that appears to reflect large excess demand for labor. In addition, there is evidence that inflation has become more responsive to labor market tightness than was the case in recent decades. These changing dynamics may or may not persist, and this uncertainty underscores the need for agile policymaking. These uncertainties, both old and new, complicate our task of balancing the risk of tightening monetary policy too much against the risk of tightening too little. Doing too little could allow above target inflation to become entrenched and ultimately require monetary policy to wring more persistent inflation from the economy at a high cost to employment. Doing too much could also do unnecessary harm to the economy. As is often the case, we are navigating by the stars under cloudy skies. In such circumstances, risk management considerations are critical. At upcoming meetings, we will assess our progress based on the totality of the data and the evolving outlook and risks. Based on this assessment, we will proceed carefully as we decide whether to tighten further or instead to hold the policy rate constant and await further data. Restoring price stability is essential to achieving both sides of our dual mandate. We will need price stability to achieve a sustained period of strong labor market conditions that benefit all. And we will keep at it until the job is done. Thank you.
Okay, so that volatility that we just saw while he was speaking, that is now done. So now the market has to react, right? Some people were long, some people were short. Some people had hedges on their long trades. Some people had hedges on their short trades. new speculators are going to start to step in. News bots are going to react to what he says. So there's a huge amount of digestion that the market needs to do now. So for the moment, I don't see any edge here. But as soon as something turns into support or turns into resistance, an edge will begin to form. And then all the unwinding will begin. So, Charles, are you telling me it can't just go sideways in this range the rest of the day? Of course it could, but that does not seem likely to me. Will says, stars and clouds. I had a feeling his economic trading is through astrology. All economic, everything in economics is astrology. This is, the more you study it, the more you understand it, it is all totally random. Anything can happen at any moment. Bigger picture, whether you're talking about trading a single stock or a single market intraday, or you're talking about the world's economies as a whole. The way an economy has to work, the way a market has to work is there has to be uncertainty. If everybody knew what was going to happen and everybody was right, the market would have no reason to move. If the market had no reason to move, there'd be no reason to invest your money in it. If nobody's investing their money in the market, then nothing can change. Nothing can grow. No new companies can be developed. No new products can be invented. So for the world's economy to work, period, it has to be random, and there has to always be complete uncertainty. This is what makes a market. It's that old saying, history doesn't repeat, but it rhymes. You can look at past events to give you a clue, but you never, ever know. Okay, so I'm starting to become very interested in yesterday's spike down. That is basically below 4,400. If we start to spend some time down here and start to bring in some volume, that will be bearish for me, that we want to explore lower prices. But if we keep just poking in and then boop, pulling right back out, that would be bullish that buyers are using this as an area to step in. Yeah, it looks like no Q&A today, which honestly, I'm happy about that. just get it over with. Falcon 1 says, in Bookmap, how do you know if orders are pulled or orders are filled? Well, basically, you just look at where the liquidity is, and then you compare it to how many contracts trade at that level. So, for example, we've got some liquidity up here at 44.10, right? We can see we got these big old candles over here on the current order book. We can see the color in the heat map. So what happens when the market gets up there? Does it push, 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 and then we get a big old volume dot, right? Or do we push, 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 and then it disappears, the color changes, and the market turns around and heads lower? Then we'll know if it filled or not. It's not an exact science, but it just gives you kind of an idea. Okay, so moment of truth here. As I've said, we're back down in the spike. We're back below 4,400. So the question is, do we get new selling down here? That would be longs getting liquidated and new money sellers entering the market. Or is this just a dip? Does the market just poke down, get good taper, and then turn around and head right back up? The more time we spend down here and the more volume we bring in, the more bearish it becomes. Thank you very much, Maya. Appreciate you. Scott, yeah, he's done talking. It's over. And he said nothing new. Literally nothing new. And he said it like a robot, giving away nothing. Nothing. All right, well, we have new selling down here in the spike down. That is bearish to see. So I am officially bearish. I'm looking for the market to head down and test the week reference at 44.84. I remain bearish as long as we remain below the halfback at 44.09. Nope. It happened as soon as I said it. John Q. I hope next time he starts speaking in Spanish, oh man, the market would not know what to do. All of a sudden, stocks of Mexican and companies from Spain just start shooting through the roof. Look at that. Base the B period single prints exactly at the base of the spike down. That is going to be resistance. For sure. Okay, market just created a poor low. It is common for the market to bounce on a poor low and then come back down to repair it. And never mind, it just instantly repaired it. So the market is now one time framing to the downside. That is bearish to see. It is a sign of momentum intraday. So we are looking for resistance and continuation lower. Obviously, we don't want to use the B period high as cessation like we normally would. So I'm happy to use this level that was half back earlier. We'll call it 44.09. That would be cessation to me. So as long as they stay below there, they're likely to keep that trend going. And if they get back above it, the trend's probably over. Welcome, Leroy. Thank you for the sub. Appreciate you. Nani, that's awesome. Congrats. David says, is there really support at 43.81? I think it's weak and could go lower. It absolutely could go lower. But how do we know? You know how we'll know? If they crash right through that support. What could be a sign that it's not going to keep going lower? If it bounces on that support. Right? Does that make sense? So we want to be aware of where support and resistance is, even if we think we're going to crash right through it, so that we can observe the behavior when it gets there. This is an area with a lot of volume on the cumulative. So a lot of business has been done here before. It's an area where we ran out of steam yesterday in the regular trading hours, and an area where we ran out of steam in the overnight. So yesterday and last night, they couldn't take the market lower. So we want to be aware of it today. That might be an area where they run out of steam once again and turn around. But if what should happens doesn't, well, then we know it's bearish for further downside continuation. We then look for that support to become resistance. So do I think it's going to hold? No, I do not. But I want to be aware of it just in case it does. Another thing that's worth noting on the overnight range, this is, I mean, it's not exactly a 45-degree angle, but this is, you could call it a 45-degree angle. One thing in market profile, or sorry, two-way auction process is that if the overnight range creates a low with a 45-degree angle, it will act as very, very strong support. So it doesn't mean the market can't break it and go lower. It just means it's going to really have to poke and grind and work its way through there. One more piece of information to consider. All right, well, things are getting bearish. It's beginning to look a little bearish. There's the repair of that weak reference. So we now have lower highs and lower lows on the daily. That is bearish to see. We also have value. I mean, it's just barely, but it is overlapping to lower. That's a little bit bearish to see. And the ticks are staying below the zero line. That is bearish to see. And once Powell finished speaking, and we re-entered the spike from yesterday, that is also bearish to see. So we are beginning to build some serious bearish momentum here. Now we're testing that support. The bulls' last chance to save the market. Can they hold it? Pavel, yeah, let's take a look at the NQ. Oops, same exact thing for the NQ. So they got a lot of support in their overnight range. Yeah, they got tons of support here. So it's going to be a grind to get lower. But they are now one time framing lower, value overlapping to lower. They're inside yesterday's spike down. So it's going to be a little more work to push the market lower, but they are bearish. I would use the A period high as cessation on the Q. So as long as they stay below 14,955, it remains bearish. Okay, so once again, we got the tick smack down at the zero line. We're spending all our time and bringing in all our volume inside that spike. So that now increases the odds. We're going to test the overnight low at 43.78. New selling there would be bearish for continuation lower to head down and repair the weak reference at 43.67. So, of course, we don't expect it to drop like a brick. But if we poke below, come back up and get some resistance, that's the next target. I also feel like at some point, I can't predict when, but we're probably due for a little bit of a liquidation, as there will be buyers from earlier today who have yet to be squeezed. And somewhere below that overnight low, they'll get squeezed. And the market will liquidate. Hard to predict where, though. Here we go. Little liquidation. Boop. Boop. Buyers getting squeezed. Mark says we got to test the 4350s area. I don't know. Let's wait and see once we repair 4367. Remember, a liquidation break actually strengthens a market. So I could see a scenario where the market heads down, it repairs this weak reference, it comes back up, it gets cessation, and then it just kind of goes sideways in here. I could see that happening. Now, I don't know. That's not the prediction I'm making. It could, of course, keep heading lower all day, for all I know. and we'll stick with the momentum as long as they have it. But it is worth noting that as the volume gets thinner and thinner at the lows, and the market after a liquidation, then the momentum will run out. But for now, we still have new selling, so they're still going. David A says, how do you pick a time to get out of a trade in this situation? Sell resistance, take profits and support. If there's a reference that you think is going to get repaired, so for example, let's say the market comes up, it's testing that overnight low, it's getting resistance. You could short it there, and then you could take profits when it passes through the week reference. Or you could not, right? You could let it pass through. Watch for the next move. Watch for the next move. Wait for cessation. Whatever tickles your fancy. Okay, so I'm seeing we have a pink candle in the volume profile below the overnight low. So I'm going to click over to look at the ticks and see, are the ticks below the zero line? Yes, they are. So that is new sellers entering the market, which is bearish to see. JK says, I just wanted to know what week reference that you always refer to means. Yeah. So I'm going to try to explain this very quickly so I don't have to go into my 10-hour-long diatribe about the two-way auction process. But think about the way that an art auction works, right? They bring out the painting, they start the bidding. Do I have $1,000? Do I have $1,000? You know, somebody lifts up their hand. So then, boom, the auction starts, right? Then they lift the bid. I have 1,100, and then a bunch of hands shoot up in the air, right? Because all these people want to buy the painting. So then I have 1,200. Somewhat less hands will pop up than at 1,100. I have 1,300. Somewhat less hands will pop up than at 1,200. Because the higher the price goes, the fewer and fewer people are willing to do business at that level, right? And so then it'll keep going up. I have 1,400. Do I have 1,500? 1,500. Do I have 600? 600? 700? It'll keep going and going and going as high as it can until there's no one left willing to bid, right? And then what'll happen is there'll be fewer and fewer people willing to bid on that painting. So maybe there'll be 5 hands in the air at 1,500, and then there'll only be 4 at 1,600, and then there'll only be 3. You know, so it's less and less volume, right? The other thing is time. Time will change. In the beginning, that auctioneer will be like, I've got 1,100. Do I have 12? 12. Do I have 13? 13. Do I have 14? Then it'll start to slow down. 14. Do I have 15? 15. I have 15. Do I have 16? 16. We have 16 over here. 17. So the volume, the amount of hands that go up in the air gives you an indication of when price is going to stop going up, right? When it's going to run out of steam. Same thing with time. The amount of time as the market slows down and the auctioneer has to keep going. I have 14. Do I have 15? Do I have 15? The longer he has to keep hoping somebody's going to bid, the more likely that momentum is over, right? So the thing that we look for to give us a clue that the auction process, of course, the stock market is a two-way auction. It auctions up and then it auctions down. The way we look for the end of that auction is to see that tapering off in both volume and time. And so when you see a weak reference like this right here, that is a sign that they weren't able to spend enough time to truly end the auction to the downside. Now, this is from back on the 18th. This is from a long time ago. But for whatever reason, when you leave that weak reference behind, whenever the market comes back in that direction, that is often where it will go to do business. So on this day, on the 18th, in the H period, we did not complete an auction to the downside. So we left behind that weak reference. So when you hear me reference a weak reference, it just means that's where the market's going to go. It's going to go to that. Maybe there'll be buyers once they get through there. We'll have to wait and see. David says, that's what I'm trying to figure out. It's bearish as bringing in volume, but also possibly a sign of support. It would be a sign of support if the ticks were above the zero line. Remember what I said? So I saw the pink candle. So I knew there was business happening down here below that overnight low. That's very important because if the market is going to reverse and head up, that would be a great place to do it. So what did I do? I clicked over to look at the ticks to see, are there more sellers or buyers in the market? There were more sellers. So that was new hands popping up in the air for the downside. New sellers wanting to push it lower. I've got 34.77. Bunch of hands go up. 43.75. Bunch of hands go up. 43.72. Bunch of hands go up. The more volume, the more it's going to keep going down. That's new sellers. Now, if that candle had been above the zero line, I would have known its support. It's buyers buying those dips, buying to reverse it back up. But the ticks tell me, nope, more sellers. That is a sign of momentum. So it is both the volume in combination with the ticks and the location of where it happened. If people are willing to go short down here, it means they think the market's going lower. New sellers, baby. Sign of momentum. Maya says, I have a question about entries from balance to excess. Is it better to enter right after balance and have confirmation of direction, but risk of pulling back into the balance period, or do more of a wick test of the balance period, smaller risk and no confirmation? I feel like it is hard to time either. Well, let's kind of dial into what you're asking about here. Are you talking about balance areas on the daily? Is that what you're talking about? So you're talking about this box right here? Okay, I'll just assume you're talking about balance on the daily. Yeah, so basically, it all matters what your time frame of trading is, right? So if you are a swing trader, right, who's trading balance, what you would do is you would want to wait for a retest. So this morning, we're breaking out of balance. If I was going to short the breakout of balance, I would not, as a swing trader, just jump in first thing this morning, because we could find support and then boop, pop her right back up to the opposite end like we did right here, right? So what I would be doing if I was a swing trader who trades on a daily time frame is I would wait for the retest. I'd let the market come back up, and then that's where I'd decide what to do. If it's getting resistance there, I'd short, looking for a bigger pullback, probably to fill this gap. If it doesn't, if it pulls back up into the range, I'd go long. Okay. So if I'm going to go long, when it pulls back up in the range, I would use whatever the low was before that. So let's just look at this example from a few days ago. I've got my levels marked. The market dips below. It spends a day below. So the next day I'm asking myself that question, what's it going to be? Are we going to get resistance and head lower, or are we going to push through and head back up towards the opposite end? This actually, if I remember correctly, this was right at market open. We were right here. So that would be where I would have to make my decision. If I chose to get long there, I would go long and I'd put my stop down here and my target up here. Okay. So then the market pushed higher the next day. When it got back above the high from the previous day on the next day, that was a sign of momentum that we were trying to get up to that opposite end. So at that point, I would have moved my stop above my entry to take risk off the table and seen, can it get to my take profit? Now, what happened yesterday is just very rare. It's just not common you engulf a previous 2 days range and reverse all the way to the opposite end of balance. That's not very common. So in this scenario, I would have been stopped out for a very small gain, right? But that's okay. I mean, that's trading, So it would be the same thing to the downside now. As a swing trader, today I'd be saying to myself, okay, look, we just broke out of balance. So tomorrow, let's see if this turns into resistance, or maybe later on today. Let's see if this turns into resistance. If it does, I would short it there. I'd use volume profile to pick my stop somewhere inside of balance and then look for it to move lower. Once it spent, another day down here, I'd move that stop below my entry. Okay, so that's like as a swing trader who operates on the day time frame. So now how does a day trader use balance? Well, very simply, once I see that we got to look below and fail, I'm looking for the market to head higher. So it's just one piece of information I put in my trading. I put in my head for while I'm trading. Same thing with now, the fact that we broke lower. Now I'm bearish and I think we're going lower intraday today because we broke out of balance. So it's not a reason to go short by itself. It's context that you could use. So how do you decide where to go short? You sell resistance, right? You wait for the market to push up. You wait for the ticks to get slapped down and you get short. David G. NVIDIA now smoked. I have a feeling a lot of stocks are getting smoked now. David A. says, as a follow-up on the ticks being below the zero line as a sign of new sellers are entering the market, do you also look at the VIX? I do not. There's nothing wrong with the VIX. I'm not anti-VIX. It's just not a tool I look at. So I have no opinions on the VIX. Normally, I would talk about a low risk short up here at the C period high. Today, that trade would not interest me because the market pushed into the spike from yesterday, got new volume, new selling, pushed below the overnight low, got new volume, new selling. At this point, if they get all the way back up there, that will probably be enough to get cessation. So for now, I'm looking for resistance to hold below that C period low. If they get all the way back up there, they're likely to pop up. Oops. And then that would be the end of the trend. RK says, I keep hearing don't be long below the initial balance or short above the initial balance. I don't agree with that at all. For example, if the market were to come up, get cessation of the trend, right? We would know the downward move is over and the market is likely to go sideways. If it were to then pull back down here, that would be an excellent place to go long, even though we're below the initial bounce, to come back up, reversion of the mean. So that's not my view of things. Okay, a little bit of short covering there. GM says, do I perform the same analysis on the Russell? I do not. I don't trade the Russell. But if I was a Russell trader, I would look at it exactly the same way. Every market on Earth is moving through a two-way auction process. So unless it's some sort of derivative like the VIX or something like that, always, I would just view it this exact same way. Who's in charge, the buyers or the sellers? What happens when they get where they want to go? Do they get more sellers or more buyers? Does the resistance hold? Does the support? What's the next stop? Super Drive Guy said, did anyone notice the 200 contracts on the ES laddering up from 71 to 81? That's just short covering. There weren't enough buyers there to fill the orders. And it just happened again. All right, so moment of truth for the market. They dipped below that overnight low. They brought in new sellers, which is bearish to see. The value area is against the low of the day, which is bearish to see. The POC, the fairest price to do business, just pulled lower, which is bearish to see. So if the sellers want to remain in control, they got to smack the market down somewhere below 43.95.50. If they do, they can take it right back down to the low. And you say, why is that? How is that possible? Because the up wasn't new buyers. It was shorts covering. Okay? So that's not like strong bullish momentum got us up here. It was just people that got short down here getting squeezed. So to take the market higher, they got to bring in new buyers. But if they don't, then guess who's going to step in? Stronger hand sellers who see this as the market being on discount for a short. River, what's your read on the huge tick spike in the or the huge spike in the ticks? It's just short covering. That's all it is. It was FOMO sellers, right? People were selling and selling and selling, and they had their stops here and they had their stops here. We know why. Because of the overnight low and because of yesterday's low. When the market came back up, all those stops filled at the exact same moment. So it shoots higher. All those stops filled, so it shoots higher. But they weren't real buyers. Look at that. They instantly disappeared. So if the buyers want to keep it going, they got to keep those ticks above the zero line. And if they don't, guess who's still in charge? The sellers. And that's what the market is telling us. The stronger hand sellers are using this as a chance to the equivalent of buy the dip, but in the other direction. They're selling the rip. So if you guys recall, earlier I was talking about this 45-degree angle from the lows on the overnight and how that would act as support, and the market would have to work very, very hard to grind through it. Now the question is, does that become resistance for the next move down? All right, so I didn't even get to say it. I was about to mention, will they spoof this liquidity? And they did. Gotcha. JS says, I guess they will screw with you as much as they can before the drop. This to me isn't screwing with. I know what you mean, and that absolutely happens. This is not screwing with. This is just normal auction behavior, right? It's emotions, right? It's traders getting themselves long, getting squeezed, getting short, getting squeezed. It's just gambling happening here. Good old-fashioned gambling, baby. JS said 2 dudes got some jail time for spoofing, made millions though. Yeah, we were just talking about that yesterday. They made like 10 million and they got fines of like 50,000 or 20,000 and 1 year in prison. And I was saying, doesn't it seem like, wouldn't you do a year in prison for 49 million and whatever amount? Falcon One says they spoof all the time. What are they talking about? Yeah, well, technically spoofing is illegal, but yes, they do it all the time. It's just incredibly hard to prosecute, right? Like we can sit here and see spoofing happening every day in the ES, but for, whatever institutions have to investigate and prosecute and blah, 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 it's just very hard to hold anyone accountable. I don't know the details of that story, but it was something there was like specific stocks they were doing it on. They were able to catch them. David A says just adding and removing liquidity, that happens all day. Yeah, that's what I'm saying. That's why it's so hard to prosecute. If I put in, if 300 contracts right here, right? And the market starts to come down to it. And then right when it gets there, I pull those 300 contracts out. How can you prove I didn't just change my mind and just decide I don't want to get long? I could just say, I saw something in the chart. It changed my mind. It's like, you're allowed to do that. You're allowed to change your mind. So it's very, very hard to prove that it was intentional manipulation as opposed to just normal market behavior, Amari says, what's spoof? Spoof is when they put liquidity into the order books to convince the market participants that there will be liquidity there. So I'm not calling for a spoof here, but let's just say we've got a lot of contracts right here at 43.63. So people that are going short right now, people that will go short down here, people that will go short down here. They're targeting getting to that liquidity because they think when the market gets there, they're going to be able to take profits because there's buy orders waiting there, right? We're, of course, talking about bigger players, not retail like you and me, but bigger players are seeing that liquidity as an opportunity to take profits on their shorts, okay? So now what would happen if the market pushes all the way down here, and then right when it gets there, poof, that disappears. Well, then all those people that went short are going to start to panic. Oh no, it's something happens. And then that causes emotional moves. So what they do is they put liquidity in the order books to pull the market to it. Then they disappear it, and it either causes the market to reverse or crash right through, depending on how the participants are betting prior to getting there. And it happens every day on every stock in the stock market. So can anyone tell me what has changed about the market since we pulled back up into this overnight range here in the D period? Can anyone in the chat guess what's starting to percolate in my mind as an important piece of information? Yes, the ticks, but that wasn't what I was talking about. More guesses, more guesses. Man, no one? No one? Time, guys. Time is what I'm thinking about right now. How quickly we move down. And then as soon as we got back up in the overnight range, we're just going nowhere. We're just spending all this time bouncing around inside the overnight range. So yes, the ticks are another signal. They reversed and they're back above the zero line. That is a sign of buyers stepping in. But we're going to print a new TPO in 4 minutes. And to my mind, that is going to be the deal or no deal. We're either going to print the E period and then get cessation, in which case the fact that the momentum in terms of time is over to the downside was the signal that we were going to get cessation. So if they want to keep the market going lower, they need to push it down back below that overnight low. And I mean, in the next 5 minutes. Time is not on their side. No, it's not. For the sellers. Jay says they can flip it in seconds. Oh, yeah. As long as they're still trending, they could instantly take it lower right now. But it's going to be a lot harder in 2 minutes. Remember, we're talking about it as an auction process. The fact that we pushed down below here and we were bringing in new sellers in the C period, that was bearish, right? It was bearish that they wanted to keep the market going lower. But then in the D period, we came back up into that overnight range. And we've spent all the time and brought in all the volume up here since. So that is just not bearish. That's a sign we may have run out of sellers. But it's too early to make the call, as the market is still trending. Here we go. I bet you there's a bunch of icebergs doing this on Bookmap. Oh, yeah. Nope. There it is. That is cessation of the trend. Just in the nick of time. So now guess what happens? We print the next TPO. Probably backfill these single prints. And then they take the market lower. But you see, now we have some information that we can use to our advantage. We recognize, because we didn't spend that much time down here below the overnight low, that there isn't sellers down here. So if the laggards step in right now and push down here, we're not trying to get short for further downside continuation. We're watching for when those laggards run out. Because once those laggards run out, we're going to come right back up. So in my mind, the market is now rotational, and the highest probability is that we're just going to go sideways from here. Whenever the market gets cessation of the trend, the end of the trend, which we just now got in the D period, there is often one last set of sellers that will step in. They are called the laggards, and they will push it as far as they can. But whenever they run out of momentum, we come right back to the fairest price to do business, which is currently at 43.9450. And then the auction starts again. And then they push it up, and then they come back down, and then it starts again. And then they push it down, and they come back up, and it starts again. And they just keep doing that all day until they're able to break either the D period low or the B period high. So if I had to pick support levels of interest to me to the downside, I would say around 43.75, 43.70. And then if I can get a chance to buy some support very close to the low, that would interest me as well. all of which would be targeting coming back to that fairest price to do business. Okay. And if later in the day the market pushes up, I would be looking for resistance around 44.13 and 44.20 to get sellers to bring it back down again. In my mind, it is now a reversion to the mean market where they will push it down just to bring it right back up. They will push it up just to bring it right back down. And if they want to go somewhere new, they got to get down below the D period low and bring in new sellers there, or above the B period high and bring in new buyers there. And I don't suspect that's going to happen, because now all of the tension that was built up this morning, we talked about this. There's a lot of people who are long. There's a lot of people who are short. Once Powell is done speaking, the shorts are going to have to take profit somewhere. The buyers are going to have to get squeezed. Well, the market has told us those buyers got squeezed. Those sellers took profits. So now we're back to equilibrium. And it's a Friday. So I am looking for rotation. Thank you guys so much for joining me. I really, really appreciate it. If you're not a member of the brigade, I would encourage you to give it a try. I keep the price point at $10 a month. And the reason is because I don't want anyone to be afraid to give it a try. You know, $10 is less than one tick on the ES. Literally less than one tick, and you've paid for a whole month of guidance every morning. And I do that because I want to help traders have some insights that can give them a little bit of an edge. I'm not always right, but I am always doing the best I can. So if you haven't joined the brigade, I encourage you to give it a try. There's a link in the description, and we'd love to have you. Ken says, can you talk about moving out of rotation and back into a trend? Yeah, so I don't believe that's going to happen today. Again, I just explained why. But if it were to happen, there would be signals that would take place. So let's say, for example, it was going to break the low and it was going to continue to trend lower from there. So the first thing that you would see, the market would be pushing lower, the price would be pushing lower, and the ticks would get down below the zero line and they'd stay there. Every time they'd come back up, they'd get smacked back down. If the market is going to be rotational, they should be able to pass through the opening price again and again, like they just did twice here in the last half an hour. That's what should keep happening if the market's going to keep rotating. So the first signal that they might break the low is if they keep pushing lower with price and they hold those ticks below the zero line. So let's say you're getting near the low and you're watching those ticks and they're trending below the zero line and you have those sellers. Well, then you'd be saying to yourself, okay, what happens at support? Right? You got a node of support right here and a node of support right here. Does the market push down and just boop, bounce right off? Or does it push down and just keep going? If you have the ticks and you have no support, that is the first sign they're probably going to try to take the market lower, right? If they push the market down, they get below the D period low, the next thing you're looking for, they should turn that into resistance. So if they poke down below the D period low, they come back up and they don't rotate in, they get new sellers there, well, then they're going to head lower. That is what I call a breakout of rotation. However, you should be cautious because it is not uncommon for the market to just poke below, testing it, and then boop, come right back up to the POC. So you want to see those new sellers before you get into a short trade for continuation lower. Okay? So with the E period backfilling those single prints we left behind in the B, we have pulled the value area back up from the low of the day. So the value area is now also confirming that the center of the range is the fairest price to do business. People that are doing business above value today are likely overpaying, meaning that the sellers have an edge up there, and people that are doing business below, the buyers have an edge down there. So the market is rotational. Act accordingly. One Punch Panda says, any chance the market will test new highs? I do not believe so. That would be, I don't want to say it's impossible, but to me, there's like less than a 5% chance that we make new highs. I do believe there will be resistance waiting when we get up there. There'll be sellers waiting to go short. The buyers will be taking profits, will run out of steam, and will come right back down. This could just be the back test on the daily of the breakout. So we broke out to the downside. We may just go sideways today to back test that line. So I wouldn't look at it like a look below and fail just yet. But if they did get above that high, then I would know it was a look below and fail, and I'd be looking to get to the opposite end. Big range, very emotional day, and it's a Friday. So probably we're not going anywhere from here. Except back to the fairest price again and again and again. All right, thank you very much. I will see you all Monday morning on the Bookmap stream. Have a great weekend. Happy trading. I love you all, and I'll see you next time. Bye.